G'day there. Welcome to the closing bell on the 10th of September. Doing it today from my parents' place up in Sydney, where it is pouring with rain. And today I'm going to just give you a big overview of the market. I think it's worth looking at the things I'm always showing you, the bonds in the US. We've got Europe raising rates by 75 basis points. Currencies are starting to fly all over the place. We've had quite a bit of weakness across the board in equities. I just want to give you that big picture overview of the things you need to watch out for going forward, just to get a sense that you're not getting sucked in to the bear market rallies as they happen, and that you know where the big picture pressure points are at the moment. But just to kick off, I want to show you some results from my trading service over the last 3.5 years. I'm just doing a presentation that I'd love you to join. There'll be a link showing in the video that you can click on to just watch that presentation where I just outline how I approach things, the stocks I trade. I'm pretty conservative in the way I go about things. And you can see, though, that over the last few years, if you had 100 grand as your starting figure when I started the service, and you just invested, risked 2% of your capital on each trade that I sent out. So we're saying if you had 100 grand to start with, you're only risking 2% on each position. So that's 2 grand. If you had done that over the whole period, you'd be sitting on 275,689. And that's actually at the end of June. And that figure has actually kicked up. We've had a bit of a rally. It's actually kicked up to nearly 300,000 over the last few months. So that's where the portfolio is currently. So, that's pretty good going. We went fantastically over the last few years, you can see. But also what I want you to note is during the crash in 2020, that was the drawdown we had. And the major thing about that is, us taking profits. What I do is we sell a third of a position as soon as I get a mean reversion event and really protect initial capital. And we had done that early in 2020 with a lot of positions. So when the crash happened, we actually got knocked out of a bunch of positions, but we didn't lose any of the original capital. So the drawdown on the account was very small. And so when things kicked back up and started looking good, we had some really great years. 1 year from 2019 to 2020 financial year up about 56%. And then in the 2020 to 2021 financial year up 96%. So, some really good going when the markets are great. And as you can see, during the period when we've had the sell-off, yes, we are having a drawdown because I'm holding on to some long-term positions, which I want to keep. But, not a complete collapse as would happen to many traders. So we're keeping the downside to a minimum and then really making hay while the sun shines when the market's trending up. And that's the idea of what I try to do for people. So if you want to learn a bit more about how I do that, please click on the link either below the video or in the video and watch the presentation. And, that will be live until Tuesday, and then that will be gone. But I think you would find that interesting if you're enjoying my presentations. So let's move on to the markets. And the thing that I really wanted to focus on today was just looking at these bonds again, because they've had quite a big move. This is the US 10-year bond yield chart, and we've been following this for quite a while. What I want you to notice is the fact that where rates are right now on those 10 years is the highest level for 10 years. So it is on the edge of breaking out. We had a rise in yields a few months ago up to around 3.5%, and rates fell all the way back to retest that 10-month exponential moving average within that long-term uptrend you can see there. So these yields really are rising at a fast pace, and they are showing that that uptrend is still in place. And above 3.5%, I'm just wondering, what happens above there? Do we start getting some forced sales? So this is the thing you want to keep your eye on, because there is a chance that we could see quite a sharp move higher if those 10-year bonds hit above a 3.5% yield. Because if we look at, really long-term chart, it looks as if the long-term trend from the, late 80s is on the edge of turning after rates have fallen, for a generation. So, that is pretty big news, and it's something that you want to be aware of because it could feed into weakness in equities. So if we move on to the S&P 500, I think the major point I want to make today is, and I've been showing you this for a while, now that we've got that long-term downtrend in place and we are seeing weakness from those long-term moving averages, as long as it remains below that recent high, which is up around 4350, 4400, you have to be wary of this market. Even though it is rallying now, I would expect there to be quite a bit of resistance up around that 4150 to 4250 area. And if things turn back down from there, and especially if it does break below, and I know I've said this like a broken record, but I think it's important to point out, below the low of the correction from a few months ago, you've got to be very wary about what can happen below there. So with the US bonds looking like they're looking, with the 10 years nearly breaking out above 3.5%, with the US dollar absolutely flying higher, it is a scenario where you could see things get a bit disorderly if the selling continues. So below that sort of 3,600 region, it really is game on. And look, that may not be for another few months. The market could settle down here for a while. The central bankers are in charge. They're the ones that are coming out with speeches. Some of them are dovish, some of them are hawkish, and the market is just in a tiz going up and down based on what they're saying, because it's all about where these interest rates go from here. And the bottom of that correction in the S&P, 36.39, below there, I turn very bearish on what could happen. And really, I'd like to see a big clear out. And I think a huge clear out down to, could be 2,400 to 2,800. Down there is where I'm going to start looking for big opportunities for long-term buying. But while this long-term downtrend remains, you just want to be wary. Don't be taking big risks. And it's not really until it heads back above that area that I can, change my tune, I guess, that the downside is what you have to be wary of. And it's a similar situation in the ASX 200. For me, it's a very classic setup of further weakness possibly coming. But these things can take months and months to play out. We had a speech, or I think Governor Lowe came out and was a little bit more dovish after the rate rise the other day. And so the markets turned back up thinking they're going to slow down the pace of interest rate increases. So, that could spark a bit of a rally. But as long as this whole big picture is looking like this, with a year of selling, with the market turning down, with the long-term trend turning down, you just have to be wary that there's a lot of selling pressure higher than here. But it's not until it breaks below that low of the correction that you'd get really wary of what was coming. But once it breaks that level, you're not going to have much of a chance. It's going to sell off very sharply. So that really is the big picture here. You've got to be wary of what can happen. And just don't be out there buying anything apart from, things like uranium. There are definitely pockets of the market that are doing interesting things. There's, I said 2 weeks ago to get stuck into uranium stocks. The stock that we bought, which I gave you a presentation on last week, this morning hit the initial target. Deep yellow, we bought at 89 cents just on the Thursday. less than a couple of weeks ago, or a couple of weeks ago. And today it's hit my initial target. So we'd be selling a third of that, adjusting the stop loss to a break-even level. And from then on, the market can do whatever it wants. And our worst outcome is that we get our original capital back. So that's been a great move. I hope a few of you were listening to me a couple of weeks ago, because Germany's come out to say they won't be shutting off the reactors that they were planning to do by the end of the year. So, you know, after the Japanese announcement that they are bringing things back online, now Germany backing off from shutting down, there's a real strong shift towards uranium now as gas prices go through the roof. And I think that is the area of opportunity, because it's been a 10-year bear market in uranium. It's about to flip over from a oversupplied to an undersupplied situation in the next couple of years. So there is, you know, a few exciting situations out there that you've got to keep your eye on. For example, Alligator Energy, an explorer, really has a nice looking chart now. If we just look in at the monthly chart on that one, I've got that turning up in long-term uptrend, monthly buy pivot last month, finding support where you'd want to find support. So really looking good. You'd need to give it room to move. You know, it's at 7 cents. Maybe it's one where you just buy it without a stop loss, and you're just going to ride this next few years of uranium becoming the energy source really that will help us get towards net zero in 2050. So I think it's a big story. There's a lot of money flooding into it at the moment, but I think you can start buying and be buying on the back foot on weakness. So that's it for today. Definitely join me for that presentation, which will be disappearing on Tuesday. Click the links in the video if you can, if you've been enjoying these videos and have been getting onto a few of the winners I've been giving you lately. And I shall chat to you more next week. Cheers.